All right, good morning, everybody. Welcome to the Washington Hospitality Association's webinar podcast with Rick Braa of the Advisory Network. And today we're talking about the PPP, EIDL, forgiveness programs, all of those things that Rick has a presentation set for us, so he'll be sharing that right now. And with that, Rick, I'll hand it off to you.
Awesome, thanks, Lex. So today's presentation is based on questions from the Washington Hospitality Association. And Lex, you're seeing my slide? Okay, great, awesome. So as Lex mentioned, my name is Rick Braa. I am the principal CEO of a company called A&P Services out of Seattle, Washington. And we specialize in accounting and management consulting for primarily multi-unit restaurant companies. So we're very deep in the niche. So I wanted to start out this morning, talk a little bit about the Paycheck Protection Program. There's been over 5.2 million loans through August 8th when the program was shut down, totaled about $525 billion. And in Washington alone, there are 108,000 loans totaling about $12.5 billion. Just to put that in perspective, the SBA typically handles somewhere around 50 to 60,000 loans a year and somewhere around $20 to $30 billion. So you add this to the EIDL and you're talking about 900 billion in loans and about somewhere around 9 million loans. So considerable load on the SBA, and I think that's what we've all been experiencing as far as unclarity and delays and different rules changing. So we're going to talk a little bit about that today. All right, so first question was, what are the coverage periods? So there are several different ways to look at this. The first is the traditional coverage period or the standard coverage period, which is the funding date. Whenever you got the money in the bank, the clock started ticking and you had 167 days from that point. So during that period of time, payments that are incurred and paid count towards the forgiveness period and the usage in that coverage period. So if you, for example, were to get a bill from April and you got your loan in May and the utility bill came in and was paid in May, that would be in your coverage period. So that can get a little bit tricky down as we get down towards the end of the loans, which is what triggered this conversation. So the alternative coverage period is something that came a little bit later, introduced a little bit later, and that was basically beginning with the next payroll cycle. If you pay at least weekly or bi-weekly, you were allowed, for example, if you got funded on the 5th and your payroll period didn't start until the 10th, you could start your coverage period on the 10th rather than on the 5th when you got funded. So that has advantages and disadvantages, and you need to analyze because there can be a difference in how much payroll is actually paid in that particular pay time. So some people want the coverage period to be a standard coverage period. Some people want an alternative coverage period. It depends on when you pay your payroll. So that needs to be analyzed pretty thoroughly, and you can always choose anything between 18 and 24 weeks if you like, but it can end no later than December 31st, which has been a little bit of a surprise, I think, to some people, because they thought that the PPP went through, some people thought the PPP went through December 31st, and it's actually maximized at 24 weeks. And if you got a loan after July 17th, you're actually losing a few weeks of your 24-week period if that's the period that you chose, because it has to end by December 31st. So what's included in forgiveness? Payroll excluding federal employer taxes. So the component of the loan that can be forgiven has to be greater than or equal to 60% of the loan. So you can't spend any more than 60% or less than 60% on payroll. That will reduce, for example, if you spent 50% on payroll and you had let's say you had a $100,000 loan, you spent $50,000 on payroll, your portion of the 40% that made up rent, utilities, and mortgage interest would be limited to that $50,000 component. So the $50,000 would be the maximum component on the payroll in that particular case, and then you would get basically the additional portion of that to pay, which is about 2/3 of it. So you would be reduced down to about 45,000 in that particular, I'm sorry, 40,000 in that particular case. So what's included? Wages, bonuses, commissions, hazard pay, severance, basically cash compensation for employees, and some for the owners if you qualify. Benefits, employer paid benefits, not the employee paid benefits, so you don't get to count money that the employees pay in. And the big kicker here for the restaurant industry is tips, because tips count towards cash compensation for the PPP. That is a very valuable thing because it essentially more than offsets the federal employer taxes, and you get credit for those tips towards cash compensation. Yet you don't have to count those tips towards the cash compensation minimum for making sure that there is no wage reduction. So being able to count the tips in has been a very valuable thing, and there's been a little bit of clarity around that. So I'm hopeful that whatever has been ruled at this point sticks. So rent, and that includes not just traditional rent, but rents on other things, such as your dish machine and other things that you pay rent on. Utilities, make sure you get those utility bills in, because sometimes they can drag 2 or 3 months. So we want to make sure that we get those in the coverage period. And then mortgage interest. And your loan documents really show the collateralization, whether they still qualify. So things that you have loans on that you're paying interest on, that secure assets are really what you're after, not just your traditional, mortgage on a building, but things that you pay interest on that secure assets. For example, a fixed asset, or perhaps you opened a restaurant a couple of years ago and you're able to use that equipment. You've got a loan against it. You're able to write that interest off. Include that. Now, there are some rules around owner income, and there's been a recent clarification around S Corps and C Corps. We have not seen that for LLCs and partnerships. So at this point, there's been clarity for S Corps that if you have an owner of an S Corp or a C Corp that owns less than 5% of the company, they're treated as any other employee. People that own greater than 5% are limited to that 20,833, which is 2.5/12. So they never allowed you to get that 24 weeks as an owner. You're only allowed that 2.5/12, 2.5 months of wages. So on partnerships, your partners are limited to the lesser of 2.5/12 times your K1 self-employment earnings times 92.35 or 20,833, whichever is less. So there's some limits on partnerships, and self-employed people would also follow that same ratio. So 20,833 is the most that you're going to get to claim as an owner if you're in a partnership, and you have self-employment earnings that are at least about 108,000 or more. And LLCs are a little bit tricky because they follow the tax filing structure. So if you're taxed as an S Corp, you'd follow the S Corp. If you're taxed as a partnership, you'd follow the partnership. All right, so taxability of PPP. Expenditures that are forgiven are not deductible. And this was hotly debated in the last congressional round when the next round of PPP money was approved. There was quite a lot of conversation trying to fix this. A lot of senators wanted to fix the fact that the expenditures, for example, the payroll that you're going to have forgiven is not going to you're not going to get forgiveness for that on your federal taxes. So those expenses are not deductible. So if you had a traditional year, you would get to deduct your payroll taxes. Well, if you get the amount forgiven for payroll, that is not included. So that gets excluded and not deducted. So in some cases, that can be a considerable number. If you're in the upper tax bracket, 38, 40%, they get taxed at the normal federal income tax rate. So that's something that hopefully Congress will be able to clarify. It was not the intent, of according to several of the senators, was to add this burden on. But if you had $1 million loan and it all got forgiven, and you're in a 38, 40% tax bracket, that money could all be taxable for those expenditures. So I'm hopeful that gets fixed. So many people are hopeful that gets fixed in the upcoming congressional sessions as we look towards another round. That was not, as I mentioned, the original intent, according to several congressmen, of the PPP was to slap a big tax bill on people that got forgiveness. Now, a lot of people could argue back and say, well, I'm going to be in a loss position this year anyways, so it's not going to really matter to me. But some people are doing okay, and they may end up, if they have forgiveness, they may end up in a taxable situation that they weren't anticipating. And as we know, moving into spring in Washington State, traditionally through the winter, cash flow gets very difficult, and to get a big tax bill at the end is not going to be a very pleasant surprise. So I'm hopeful that they clarify this. As I mentioned, so many others are as well. So when to apply for forgiveness? So at this point, many banks are not ready. I was just talking to a colleague. They said that the SBA's received about 100,000 applications at this point, and in some cases they're turning them back. Now recall back to the beginning of the presentation, we talked about how many loans are actually happening here. When you're talking about into the millions, 9 million loans that they're having to deal with compared to a normal 50 to 60,000 in a full year, and they're dealing with 9 million loans in basically 6 months. So that is very taxing for the organization. I don't think they can hire fast enough to be able to handle it all. And that's why they're looking at some of the rules to streamline this, because the average loan is somewhere around $100,000. So they're looking at changing the automatic deductibility to $150,000 or less, and that'll eliminate a good chunk of those loans from having to be reviewed. So I think it'd be a very simplified, streamlined forgiveness process where you basically check a couple of boxes and it kind of sails through. And the banks are really behind that as well, because it's going to be quite taxing for them. Many of them have outsourced the calculation of forgiveness and the verification of forgiveness to outsourcers because they don't have the manpower to actually be able to process those forgiveness applications because they've done so many in so many cases. You have 10 months to file for forgiveness from the end of the covered period. Once you have filed in that 10-month period, banks have 60 days to submit to the SBA, and the SBA has 90 days to approve it. So if you do not file by the end of 10 months, then you will automatically have to start making payments. But essentially, you kind of wait until you hear back from the SBA before you have to start paying your loan back. So that can be advantageous if you want to wait a little while, save up a little bit of money if you know that you're not going to be completely forgiven. So that can be advantageous to wait, kind of drag that out a little bit. So the last point on this slide really talks about selling or closing. And there is a lot of unclarity around whether you're going to be able to sell your business or close it. The only time that you would want to move forward with moving towards forgiveness is if you want to close or you want to sell. You're going to want to get your application in for forgiveness, I think, pretty rapidly. Because if it does take the bank 60 days to process that submission, it takes the SBA 90 days to approve it, you could be out as far as 5 months before you could be able to close or sell your business. So if you spent over 100% on payroll and you believe your loan's going to be 100% forgiven, then you could be okay to move forward with, to apply for forgiveness. At this point, we're kind of at the wait and see portion because the rules have been changing. So we want to make sure that we're really clear on what the forgiveness rules are completely prior to doing a whole bunch of loan forgiveness applications. So another surprising element is the grant situation. So many members have filed for an EIDL grant. There's a $10,000 or more grant that the EIDL has been awarding, sometimes with a loan of $150,000 or more. But the $10,000 grant, that's the most common from the EIDL program, is not going to be forgiven under PPP. So that $10,000 comes right off the top of your PPP forgiveness. So if you've got a grant, you are assured that if you got a $10,000 grant, you're going to owe $10,000 for your PPP. You're going to have to pay it back. So make sure that you're saving for that, because you will have to pay it back. So the other thing around the PPP is it does accrue interest, and whatever interest is accrued, even though it's only at 1%, when you have to pay your loan back, you have to pay that with it. So you're going to want to make sure that you save some money to pay that $10,000 back, or whatever you received. If a grant's received from another source, such as a state or a local government, we've seen some money coming from different entities. If you're on a particular campus, we've seen some landlords and some large companies being very generous with grants. If they are, for example, paying your rent, you don't get the double dip on that one. So if you get a grant for rent, for example, from an entity or a government entity, that's most likely not going to be forgiven for PPP. They do not want you double dipping. So keep that in mind if you've received grants, that you are very clear on either setting that aside, not including that in your PPP forgiveness. So another question that's come up is, what do I do once my PPP process has been complete, I've filed for forgiveness, and I've got a balance left? A lot of people are going to have a balance left on their PPP loan. So that is still limited to the same things that you had to use the loan for in the first place. So the use of your loan, let's say at the end of the day, you've got $50,000 left over on your PPP loan, you've decided to keep it, you're not going to pay it off, you still have to use that on payroll, rent, utilities, and mortgage interest. And that can be a little bit of a surprise, because people have said, well, it's a loan now, I should be able to use it however I want. Well, in the loan docs, you'll notice as you review your loan docs that you are saying that you're going to use those loan proceeds on these 4 things. So that doesn't change even after your funds are converted to a loan. You'll also want to go back, if you've got a PPP loan, which a lot of people did prior to June, you're going to want to go back to your bank, and you're going to want to request your bank to term your loan from 2 years to 5 years, from a 6-month deferral to a 1 month or 1 year deferral. So a lot of banks have been accommodating. Typically your small regional banks have been on top of this, realizing that some people that got loans early were at a disadvantage to those that got loans a little bit later. So if you got a loan prior to June, you're going to want to go back to your bank, and you're going to want to ask them for the 5-year term, because that's what was in the second round of funding that was June 3rd or later. So you're going to want to request your bank to term that out to 5 years, and that'll give you a little bit of breathing room on anything that's left over. It also gives you a 1-year deferral. Not that you couldn't do that through the forgiveness process, but you'll want that 1-year deferral up front to give yourself a little bit of breathing room. So request your bank for the 5-year term. I have not had great luck with the national banks. They've said whatever the PPP loan was that was put in place is the amortization table that we're going to follow. But I would continue to ask and ask and ask, and not assume at this point. So economic injury loans, the EIDL. The EIDL has over $3 3.6 million loans to date, and it's still open. It's got $190 billion worth of loans outstanding. And in Washington alone, we've got over 64,000 loans totaling $3.8 billion. So the EIDL, they have terms up to $150,000 plus a $10,000 grant. That grant is no longer available. That was automatic, and about a month ago or so, they stopped giving it out. So it's a $150,000 loan. It's got a 30-year term. I love this loan. It can be a little restricting in some points, but I love this loan. 30-year loan, 3.75%, 1 year deferred. When you do the math, it comes out to about $750 a month over 29 years, no prepayment penalty, and it's to be used for working capital for economic injury. So the economic injury, make sure that you're not crossing over with PPP. So if you still got PPP money, make sure that you're not dipping into your EIDL money to pay PPP expenses. So use it for working capital, use it for other things, but don't use it for payroll, rent, utilities, interest. Make sure that you use it for working capital. This is really meant to get you through this economic injury and give you an additional source of capital, and a good source of capital, I might add. As I mentioned, $750 a month or so for about 29 years, no prepayment penalty, means you can pay it off at any point. So, which will be important because I don't know a lot of restaurant owners that are going to hold their restaurant for 30 years. So when you go to sell your restaurant, you'll need to pay this loan off with it. So it also carries no personal guarantee if it's less than $200,000. It does secure your assets, so you are going to want to talk to your bank about obtaining an EIDL loan. Most, if not all, will say that's perfectly fine. So it's not a cost preventative loan, but it does require them to work together a little bit more in some cases. So no personal guarantee, but it does put a security interest on your assets. So you do want to make sure that you inform your bank that you are going to take an EIDL loan, which they would encourage, I'm sure. All right, so business closures and sales for PPP and EIDL. I mentioned this a little bit earlier. Guidance is really lacking on this. It's not clear, but in your loan documents, there may be stipulations that require you to get bank approval before you have any kind of sale or closure, and that will also involve the SBA. So closing or selling your business is not as straightforward as it once was. The real risk here is that they could just call the loan and say, give it all to me. And if you spent it, that could be a problem because if you're trying to sell, there's no personal guarantee. You've used up all the money, and you sell the business. They don't know anything about it. They could come in and put a lien on the business. So that would not be popular with the purchaser. So make sure that you keep them in the loop around closures and sales, because I know that we're entering a very difficult time for a lot of operators, and we are going to see, I think, a pretty good amount of closures. And so you're going to want to make sure that you're in lockstep with your bank if that's something that you're considering, and your attorney. And as I mentioned, the guidance is really not clear on this as to what you can do. We've been working on this for a couple of months. So, and we've got great attorneys working on it. It's just not very clear what's going to happen. And I know there was a congressional hearing earlier this week, the last week of September, and the senator replied and said that they were really hopeful to have an answer on some of this very soon, what can happen here, because it's going to leave people in a real lurch if they can't get out of their business and they need to. And then if they got a larger above the 200,000 that involves a personal guarantee, that becomes particularly sticky at that point. So Lisa, have you received more questions regarding PPP and EIDL?
Yes. If one of the questions is, if we got a grant for the PPP That means that the PPP is not forgivable even if you meet the other criteria?
The amount of the grant is not going to be forgivable. So if you've got $10,000 grant, that's going to come right off the top of the EIDL or the PPP loan application and not be forgivable. So the real thing here is you can't double dip between the two programs, and that's what they're trying to prevent, is the double dipping between the two programs.
And the next question, does the deductibility status change after the PPP is converted to a loan?
I'm a little bit unclear on the deductibility as far as the expenditures go. If you're converted over to a loan, the expenditures are because you're not going for forgiveness. That's really what that is about. Is they don't want you to, at this point, the way the rules are written right now, is that you don't get to write off those expenses that you get forgiveness for. So once you have it converted to a loan, you would get to write off those expenses, yes. So payroll and things, because there is no forgiveness.
And a question about the EIDL loans, EIDL loans. Once you've used up your PPP funds, can you use EIDL funds for payroll, rent, etc.?
Yes, from what I've seen, it is a working capital loan, and once you have used up your PPP loan, you should be able to use those EIDL loans to keep going. It's really that those loans, the great thing about them is they're really meant to get you through an economic injury. So it's whatever you need for working capital to keep the business going. They don't want the business to fail. And they propped it up with the PPP. They're coming in over the top at the EIDL to make sure that you can get through this economic injury, because it's severe, as you know, especially in our industry. So those loans are really meant to be working capital loans. Once the PPP money runs out, you should be able to use those for the same things to keep the business going.
Okay, those are all the questions we have for now.
Okay. All right, so let's talk about what happens after EIDL and PPP. So I have been fortunate to work with a lot of different operators that are actually doing okay and that are doing well. And we'll have a whole separate webinar on this and blow these out a little bit. But the ones that have done well, after your PPP's gone, and there's no more money there, and hopefully there'll be another round coming up, and there's the HEROES Act that's just been reintroduced, and it's been cut back by $800 billion, so it's a little more attractive. Two main things in that act that we were particularly interested in is the Restaurant Act of 2020 is in there, the $120 billion fund, as well as the new round of PPP. That's a couple $100 billion. Reusing the money that was not used last time and adding about $60 billion to it. So we're very hopeful for that act, but there's some sticking points in there that might make it a little bit difficult to get through. So let's assume for a moment that there is no more PPP coming, because I think that's the way to move forward. It's the only way to move forward. So the first thing that all of these strong operators have in common is they have high owner direction. When things fell apart, even though they may have larger organizations, the owners came in and gave straight direction as to what was going to happen. And in retrospect, if you think about companies that have multiple units, the reason that they were really successful in the beginning is because they had owners that were really involved in everything. So the first characteristic is to be really involved in direction. And direction is really another word for telling people what to do and the way it's going to be. And some people might call it micromanagement, but what I've seen through the most successful companies that we've worked with through this span is their owners are extremely involved. They didn't just leave it up to their team. They got involved from the get-go, and they've stayed involved. The second characteristic is they have strong GMs in their locations. And this is a great time to bolster your team. So don't be afraid if you've got a weak team, to bolster that up. You need to have a strong GM in your location in order for you to be able to operate well, especially if you've got more than one location. But the GM has the ability to kind of scale up and scale down. As my colleague said, during the recession, everybody works one level down as well as their own job. So it's important for the GM to be a strong GM so that they can move down and they can stay at a higher level as things improve. Third area is they can pivot at every turn. And this is key right now because the rules continue to change. We used to have 50% in occupancy, and now it's 50% with the same family or the same household indoors. We're starting to see, outdoor is going to start waning a little bit when we have more rainy days. So we need to be able to pivot indoors. So the operators that have done really well have pivoted at every turn, whether it's the beginning, where they did a lot of takeout and meal kits, whether now it's indoor, outdoor dining, converting the outdoor space, getting it ready for the rainy season. In fact, some even into the winter to try to turn their patios into 4-season patios, but the restrictions of really 2 walls. So these strong operators have really pivoted at every turn. They've also raised expectations. While excuses are easy to come by, the strongest operators have said we need more out of everybody. And I have always held to the belief that our industry has not been particularly productive. And as we've gone through this, we've had the opportunity to optimize hours and increase people's productivity. And raising expectations has been a thread that's run through all these successful companies, because they have held their people accountable, and they've asked for more out of people. And guess what? They've gotten more out of people. So the next one is to execute flawlessly. And I've got plenty of stories recently from going to restaurants where the execution just seems to be sloppy. And something as simple as full hands in, full hands out just seems to be getting a little sloppy in our industry. And those that are doing very well are really tight. They're executing at an extremely high level. And guess what their number one focus is? Even with everything else they're doing great, we have to execute better. We have to execute more flawlessly. We have to do better on our execution. So whether that's making sure that you're packing the bags correctly for a to-go order, that you're watching your Yelps and what other social is out there, that you're executing with speed and you're executing with precision. That is a common factor among those that are doing very well right now. The next is to be visible. So this is a time more than any other to be out there and being visible, to be doing good, to be supporting the community, but to also be pushing your message out that you're here, you're raising your hand, you're saying, I haven't gone away, I'm open. Here's when I'm open, and here's what we have going on here. So being visible, coming up with different ways to be visible, not avoiding the advertising type of scenario, social media, making sure that you're remaining active, because as things begin to reopen, there's more and more noise, there's more and more operators that are out there, and those of you that have remained strong through this need to continue to push your voice out. Before all of this happened, we were up against an industry essentially that was competing against itself. It had so much growth that in especially urban areas, we were squeezing everybody with a little bite here and a little bite there and a little bite here and a little bite there, to where margins were eroding, sales were declining or flat. And so as we went through this current crisis that we're in, we've seen more businesses kind of stay closed, and the strong have started raising up again. And it is time to be visible more than ever. The next is to have strong systems. Now's the time to study your data, to make sure that your engineering is correct around your menu, to make sure you're selling the items that you want to sell, that you're purchasing things correctly, that you're not just accepting higher prices on items. We've seen a lot of that, a lot of pressure on margin coming out of the provider side. A lot of that has to do with, packing plants closing and things like that. But working your systems, looking at your information every day, every minute, how did labor go? Being really disciplined. Now's the time to be more disciplined than ever. I've always been a big fan of weekly inventory. I seem to lose that argument more often than not. People do it every period or every month, whatever fiscal calendar you're on. But now's the time that you really need to watch your inventory, even on a weekly basis, because every dollar counts. The larger your sales are, waste as a percentage of sales kind of diminishes. But when you're slower and your sales are down, waste as a percentage of sales go up, and you start seeing your costs creep up. So now's the time for you to really work your systems, to really to make sure that your checklist, your opening and closing checklist, to make sure that safety is going on at a high level, that cleanliness is top of mind, that you're engineering your menus, that you're purchasing great product, that you're watching your numbers on labor every day. Even though you're trying to get people hours, you still need to manage those metrics, because if you don't, you're going to lose money. And right now is not a good time to lose money as you kind of go into the slower time of the year for a lot of operators. We're not going to see a lot of private dining this year. So in fine dining, where we've traditionally kind of lived on larger parties through the holidays, it's going to be tight this year. We don't know what it's going to look like. Perhaps there's going to be a little bit of relaxation, perhaps not. So we can't bet on that. We have to bet on what we have in our hand right now and operate at the top optimum level that we can now. And that's really working your systems and making sure that they're strong. And if they're not strong, strengthen them. Now's a good time for that. We've got a little bit of extra time. A lot of people aren't operating at the same hours that they were before. So strengthen your systems if you feel like there's a system that's weak. And be scrappy. Being scrappy is doing whatever you need to do. As Howard Schultz said at the beginning of this, just earn one more dollar every day. That's what we're after, is make another dollar every day. What are the things, the scrappy things that need to be done in order for you to survive through this whole thing? And not just survive, but to thrive and to transform. This is really about transforming your business. Things won't be the same for a while. So you've got to transform your business, whether that's developing another brand and putting it in your location and doing a ghost kitchen out of there, whether that's pivoting to a different type of service model from full service to limited service, redoing your facility to be more streamlined and efficient. Now's the time to be scrappy. Get back in there. That goes back to number one, where we talk about high owner direction. Get scrappy. Then have an ownership mentality from top to bottom. I had a meeting the other day, it's a great meeting, and one of the GMs basically said, I've got to treat this company like it's my dollar that's going out of my pocket. And it's really helped me to change the way I think about this business, because every dollar that we don't make is a dollar out of the owner's pocket, and that dollar may not be there tomorrow. So I've got to have an ownership mentality around everything and be on the side of the owners. Got to be in lockstep with the owners to make sure that every dollar that we get, we push through, that we can have the maximum flow through. And the last thing that I've seen in common among all of these is there is hospitality. And going into this crisis, I was observing a little bit of a lost hospitality. That we were kind of losing our step a little bit on the hospitality side, and now's the time to get it back. And the operators that are doing very well are warm, they're welcoming, and they're thankful. And my understanding is some of the guests haven't exactly been accommodating, that they've been a little grumpy as they've kind of come out of their hiding spaces for the last 6 months. But remember, our job in hospitality is to restore the guest to wholeness. We take people that are tired, hungry, grumpy, and we restore them back to themselves. We restore them to their normal state, in fact, an elevated state. So be sure that hospitality is at the very top. Whether you are limited service or full service fine dining, hospitality is at the top of the list of these great operators that are doing well through this. And doing well is a relative term. That's not like sales are up 200%. So doing well is a relative term. That making it through and thriving is really what these characteristics are all about. So pick one or more of these and put them into practice as soon as you can if you see any holes. These are the common characteristics that the great companies coming through this are exhibiting. Lisa, more questions?
Nope, we don't have any right now, but if anybody has any, please feel free to drop them in the chat.
Okay. So we'll hang out here for a few minutes. We were able to get through that pretty rapidly. Lex, any other questions that you've received in the interim?
Well, I think one of the handling some of the myths and access to funds out there. What exactly is currently available? Because there's obviously the finite amount of funding for PPP, not necessarily available, but then there's still EIDL money available, correct?
That's right. Yeah, and the EIDL money, I still don't understand why it's not all gone, because they're really good loans. And the great thing about the EIDL money is it's very quick. When you apply and that money is in your bank in 2 or 3 weeks, it is very quick to get to you. And you got to remember there's restrictions around uses around those, but it is fast, and this kind of money can actually get you through, you know, this next 6 months, because we got to get to March. That's the goal. We got to get to March so that we can get back to that, you know, the beginning of Mount Rainier and our sales up in Washington State. So we got to get to March. So that EIDL money creates a great bridge. It's inexpensive. You don't have to start paying it for a year, and you can pay it off at any time with no penalty. So I would definitely endorse going after an EIDL, and I'd get it sooner than later, because those things run out, and you know, that program could expire in October. And you could be wishing that you had that extra $150,000, even if you don't spend it. There's no prepayment penalty. You will have accrued interest at 2.75%, but it is a good bridge to help you get through there. So I highly encourage you. And Lex, you've had a little bit of experience with that as well.
Yeah, it's like working the exact opposite as with the bank, because I know my wife with her business, she was approved for an EIDL fairly quickly, and just because of the amount and you know, it just wasn't worth pursuing. But we have a lot of other friends and colleagues who have gotten at least a handful of people who've gotten between $80,000 and $150,000 loans fairly quickly, and it's and very responsive. I was really surprised how responsive the agency has been in regards to that. So if I'm shocked that there's still money out there, because that could be used for working capital, correct, Rick? I mean, you can't use it. So does that include things like rent and utilities, if that's part of that?
Yeah, after the PPP is gone, that does include your ordinary working expenses. They don't want you to use it for, you know, picking up your business and moving it to another county. They want you to use it to get have bridge money to get through an economic disaster and through your economic injury.
They got a question here from Diane. Lisa, you want to go ahead and read those off?
Sure. Diane would like further clarification on what happens to the $10,000 grant funds. And she's been working on an EIDL loan for 3 months and still can't get one of her businesses funded. Any suggestions on that? She's been approved, but can't seem to get it funded.
That's interesting. So if you have been assigned an agent, sometimes they assign an agent to review your loan to get them through. You might just have to plow through and sit on a hole, you know, for 2 or 3 hours. I've gotten some of that feedback, but it's really unusual that it hasn't gotten funded. We haven't had that at the very beginning. They lost all the applications and had to be redone, and there was really a mess there for a while. But it seems pretty tight now. But the $10,000, if you're talking about, if you didn't get an EIDL, that's just a grant. You're done. I'm sorry, if you didn't get a PPP, that's a grant, it goes away. If you got a PPP, that's going to come off your PPP forgiveness amount right off the top. So you will owe that back. As I mentioned, there's no double dipping on the PPP and EIDL. But once your PPP expires, you can use your EIDL for working capital, which does include those things like payroll and utilities and those kind of things that you need to keep it going. But you can't necessarily just take the money and give it to yourself either. So that's another stipulation, is they don't want you to just take the money and pay yourself with it, keep your business closed and pay yourself. So that's not what what the uses are. They want you to keep your business going.
And Rick, if you can provide clarification on the EIDL, there is one of the things that a misnomer out there is, you said that you have to provide more of a lien or more security to get that funding, and the way that the loans are written, it's fairly ominous. It's like you're signing your life away.
Yeah.
For businesses that are on the precipice of saying yes or no, or accepting the loan and not accepting the loan, what do you have to say to them with that? Obviously, if it's between this or not being in business anymore, that's an easy answer. But for those businesses that are, it would be a nice thing, but is $50,000 really worth signing my life over?
Yeah.
How do you explain to those businesses?
Yeah, that's a great question, because if you don't need it, don't take it. I mean, I have tended to be of the opinion of, let's get as much money as we can, because we don't know what winter is going to hold. So that's why I've been a proponent for scrambling and getting this. You can always pay it back. If you got extra money, you can always pay it back. There's no prepayment penalty, and that's the beauty of this. But to have that extra bit of money, $1,000 to $10,000 per employee, up to $150,000, I think is worth going after. But I certainly understand the concern. These loans were written primarily quite a while ago, and they were written for more like the agricultural businesses, where there was a hurricane, there was a tornado, there was some disaster that knocked them kind of out of business for a period of time, so they developed these loans. Well, they haven't migrated or morphed the rules to go along with them. So when you get this loan document, it can seem quite ominous. But as I mentioned, they've made 3 to 4 million of these loans already. So they've got to at some point take a look at the rules, and I think they're starting to get an idea that they need to do that. They want to deal with the PPP first, just because there's almost twice as many of those loans. So we've got to deal with those, and those are urgent in some cases, because they've got that slow and that really fast amortization, compared to the EIDL that has a longer amortization, more time to deal with things. So the EIDL, I certainly understand it's not worth it in some cases, but if you need it, you need it. And it's better than a credit card loan that they take your deposits out every month. So
now, one other myth on the EIDL, Rick, you could provide some clarification on, is the differences between the EIDL and PPP is really tethered to the number of employees you have. And EIDL is more tethered to your gross revenue, right? To the revenue that your business actually brings in. Is that correct? Because where the confusion is with the original $10,000 grant, the SBA pivoted and said that it was going to be based on the number of employees that you have. So if you're a 2-employee shop, you got $2,000 grant. But then if your business generates $2 million of revenue in a year, you'll probably get more than a $150,000 loan. By contrast, with a PPP, you could actually, even though you're grossing a lot of money, you're not going to get that much because of the number of employees that you have in your operation. Is that a correct assessment?
I think it's close. I think that there's some mystery around how they determine it, especially with the EIDL, because people popped in, the first applicants popped in a whole bunch of information and then never made a request for how much money that you were going to get. And then all of a sudden you were notified with, hey, here's your X $100,000 loan. And so we didn't really know how that was built in the first place. So it's been a bit shrouded. as to how they're determining these loans, especially on the EIDL side. And I think they've kind of come down to the portion of now of looking at it. If it's a really small business, you're going to get less. If it's a large business, they're going to cap it at 150,000. It's an easy decision for them. In hospitality, we've got a lot of employees. So where retail, you might have 2 people running around a store at noon. In a restaurant, you might have 10. So we're going to get a disproportionate amount of money because we affect, especially with the PPP, we affect so many people's lives. So that was really critical in determining. But it also had a revenue component to it. So you couldn't just have a whole bunch of employees and get a bunch of money. So it was really based on your head count and your top line, where EIDL, I think, was more based on your cost of goods, which included your employees. So they didn't ask for a ton of information on the second round of EIDL loans. You basically went through and certified some stuff. Where the first round, you had to turn in tax returns, financial statements, all of those kind of things, and they did a more thorough review. The second round was like pop, 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 which I expect is going to be much more what the next round of PPP is going to be. So I think the next round of PPP is going to be a lot less onerous than the last one. We're fortunate because we have a whole bunch of accountants on staff where we were able to pivot and get our clients' loans very rapidly. We're among the first in line because we have that talent on staff. This next round of PPP, I think, will be a little more leveling the playing field when it comes to complexity around getting the loan. So it's going to be, I think, a lot like the EIDL, where, as you mentioned, Lex, getting an EIDL loan is so quick now compared to what it was at the beginning. Where at the beginning it might take you, 4 or 5 hours. The new loan process takes you 15 to 20 minutes. So, as I mentioned, you can always give it back.
Speaking of EIDL, Lisa, there's one more question here.
Actually, we have 2. If you received an EIDL grant, can you still obtain full forgiveness on a PPP if you spend them on different things? And can you spend any of the EIDL or PPP on payroll for owners?
The 2 questions there. The first one, the $10,000 whatever grant you got is not going to be forgiven through PPP. That's going to come off the top. So that $10,000 that a lot of people got, that's right at the top of the application. It's coming right off the amount. So you're going to want to save that money. The second one is whether you can use the EIDL to pay the owners. If you're working, at least the early information was, yes, you can pay the owners if you're working. They don't want you to pay yourself for not working. But if you're in there actually offsetting shifts and you're in there working or doing whatever you do for the company and the ordinary course of business, which is really, when you look at precedent in different areas of the law around debt and so on and so forth, they use this term, the ordinary course of business, a lot. And I saw that in a loan application earlier where they said, you've got to use this in the ordinary course of business. So if you are normally paid in the ordinary course of business, you're offsetting, you're actually working. At least by the early information, yes, you could use those proceeds to do that, to pay yourself. But it's not meant to pay you and have you sit home and do nothing, close your business and pay you. That's not what it's for. It's meant to keep jobs. It's meant to keep the business operating and to contribute to the community.
Okay, and the last one we have, we had submitted an early application for EIDL and have been working for weeks to get it activated. Any advice on how to expedite it?
Yeah, if you were early among the very first that applied and you had a number that started with 2 in your loan number, your case number, those, I believe all of those got lost and you had to reapply. So if you've been working for months, it might be worth going back and reapplying. If your loan starts with a 3, I've been told that they're actively working through those if your loan number starts with a 3. So If it starts with a 2, start over. If it starts with a 3, try to get a hold of an agent and find out what's going on there. But supposedly they're still actively working on that. And you can see by the sheer volume of 9 million loans coming in when you're used to doing 50 to 60,000 in a year and 9 million coming in 4 to 6 months, it's a different game than it was. And a lot of these people, they don't know the rules they're playing by yet.
I think that's all the questions we have, and we're pretty close to the hour. Rick, any final thoughts? This has been tremendous information. I think that, whether or not Congress passes another round of PPP, there's still money available there, and there's still situations available related to people who have gotten PPP loans. So this is a very relevant topic.
Yeah, and I think, I would want to leave you with a little bit of hope. I think that the government shutdown, that was distracting. The election's distracting. The justice death is distracting. A lot of it's taken focus off of business and the pain that we're all still in. None of that has gotten any better. So I really fully believe in my heart that there is going to be some cooperation. Now, it might take, at this point, it could be a month and a half or so before we see another round of PPP. And I think that's one of the reasons that you want to look at an EIDL, is it's going to bridge, but you're going to want to be ready for that PPP as well, because there's only a couple $100 billion. The good news is that, it's limited to $10 million $10 million aggregate between both loans, this loan that would be upcoming and the last loan. So a lot of the big players are not going to get to participate, because they're going to be over that amount. So this will be targeted a lot more at small business than the first round of money was, where they were just trying to figure out what was going on. So I do want to leave you with that hope. And please take the time to go back and analyze your business, because not that you haven't been doing that, but now's the time to pour on the gas and run your business as leanly and as profitably as you possibly can.